Today I'm going to do detailed math behind selling a house using a document called Seller's Estimated Cost of Settlement. This is just a one-page document that I present to my clients before they put the house on the market and helps my clients to clarify exactly how much money they will spend in order to sell their house and how much money will they keep from the sales of the house. Okay, let's get to it. This example is based on one of my clients. Of course, I've changed their personal information, including their name. And this is the example, okay? I'm going to call them Bob and Mary. They bought their house in Fairfax County, Virginia, 15 years ago for $500,000. They put down 20% down payment, so they borrowed $400,000. They have 30-year mortgage, so they've been paying 15 years without paying additional principal and without being late to their payments, no missing payments, and they did not borrow any additional money based on their home equity. So there's no liens. It's going to be kind of simple, clean calculation. Right now it's early 2025. We're going to estimate that their closing is going to be April 15th. And the reason why I have to give an estimate closing date is because you need that date to know exactly how much money you owe if you were to pay off your loan. Also, we need the closing date to calculate how much tax we owe to the county. Okay, so here's a document. This document is provided by NVAR, Northern Virginia Association of Realtors. Again, it's called Seller's Estimated Cost of Settlement. And before I zoom in, it's just three sections. First, in blue, it's the sales price. Second, in red, it's all the money that you have to spend in order to sell the house. And in the green, that's the summary. How much money do you get to take home? In Bob and Mary's case, they are going to sell their house for $1.2 million. And in red, all the money will add up to $330,000. And their take-home money will be $870,000. And Bob and Mary were actually curious, how much money will they owe for capital gain tax? I'm not a tax expert, I'm not a financial advisor, but I'm an engineer and I'm a realtor, so I crunched some numbers for them. And what it's going to turn out to be is their taxable income is going to be about $63,000. So if they were to pay 15% tax on that, it'll be around $9,000, a little over $9,000. Okay, so let's get to it. Their sales price is $1.2 million. Of course, right now the house is not on the market. We're getting ready to put the house on the market. But as we approach the day, I'm going to continue to do CMA reports, comparative market analysis report to come up with a better price, appropriate for that time. So currently it's $1.2 million. They borrowed $400,000. So if we go into the red box and then that middle red box, the first four line items are basically trying to get you come up with how much money you owe to your bank. So in Bob and Mary's case, they owe $270,000 because they still have, the remainder 15 years mortgage payment. But this is just the principal. That would be the balance if they were to pay off on April 15th. You can get this number, just go into your mortgage bank account, and there should be a button that says loan payoff. And if you click that, it'll ask you what day are you paying it off. And if you provide a date, it'll spit out exactly how much money you would owe at that time if you were to go clear on your mortgage. The next line item is seller's contribution to purchaser's closing cost. Sometimes agents use this to attract more buyers, but in this case, we're going to leave it zero because my recommendation was ask for the price that you would be happy with, and let's just sell it for that and not offer additional money. And also, this price is going to be compatible, if not more attractive than what the house is showing, like how the house is presented. They've been actually working with me for the past 4 months. They've been doing a lot of work. Detail cleaning, not just cleaning, detail cleaning. They've been decluttering, putting away stuff in storage, getting rid of stuff. They've actually replaced their upstairs bedroom carpets into a brand new carpet. The house is looking very nice. And as we get closer to putting it on the market, I'm going to help them with staging. And so it's going to be very nice. So relative to how the house is presented, this asking price is very competitive. So therefore, we're going to leave the seller's contribution to purchaser's closing cost 0. Seller paid lender fee, none. We have conventional loan. Prorated city or county property tax, that's $2,667. So you'll be asking, Achma, first, how do you calculate this number? Second, why are we paying county tax? Don't we pay this to our mortgage company? You are correct. Just temporarily, for about a month, you'll pay the county property tax twice. On the closing day, you pay from whenever the last time that you paid the tax until the closing. So in Bob and Mary's case, they're going to have to pay from January 1st up until April 15th on the closing day to the buyer. After the closing, their mortgage company is going to do audit on their account and calculate exactly how much money they owe to you, and then they'll send you the check. Or if you provide them your bank information, they'll wire that money to you in about a month after closing. So in Bob and Mary's case, if we do end up selling on April 15th, they'd already paid April mortgage payment. So in addition to the tax, they'll also be receiving the second half of their mortgage payment that they paid. Okay, how do I calculate this number? It's basically from January 1st to April 15th, that proportion relative to the whole year. So just to give you a little bit more background, Fairfax County charges 1.03% from their assessed value from each property. So their assessed value is $900,000. If you multiply that by 0.0103, last year they paid $9,270 for their property tax. So if I get just the portion from January 1st to April 15th, that's 105 days out of 365 days. So that's 0.287. That's the fraction of the year. Multiply that by the last year's $9,270, you get $2,667. And that's how you calculate that. So if the closing date changes, that's going to be a little bit different. Okay. Unpaid HOA, condo, or co-op dues, or special assessment. Their house does not belong to any HOA, so this is 0. Other prorated taxes or liens, 0. Listing company compensation, that's the seller's agent compensation. Selling company compensation is the buyer's agent compensation. I'm not allowed to say exactly how much money I charge publicly. I'm only allowed to talk about it with my clients or my broker. And I put this $50,000 vaguely, not exactly in a specific cell, just so you can add up all the money and subtract it from the sales price and see how much money you get, or in this case, Bob and Mary get. And this is not what I charge. Okay, it says right here, it's not what I charge. The next line items are settlement fee, the money you have to pay to the settlement or the title company for orchestrating all the document. They have to do all the scheduling, moving money around, coordinating all the documentation, recording title. They have to communicate with all the parties in the real estate transaction, the buyers, the buyer's agent, the buyer's brokers, the seller, you, the seller's agent, me. my broker, the mortgage companies from each party, the county, the city, all their banks. So for orchestrating all this documentation and scheduling and transferring money, they get paid, let's see, 500 plus 200 plus 100, okay, roughly. When the deal is done, about, let's say, within a week from the time that you have a ratified contract, you'll know which settlement company the buyer chooses. Then you'll know exactly how much money you'll have to pay. It might vary $100 or $200 up or down. And the reason, real quick, the buyers choose the settlement company is because they have to pay title insurance, and if they have a mortgage, they have to pay the mortgage title insurance, and they have the choice to shop around because that insurance costs thousands of dollars, and it could vary from settlement company to settlement company. So they have the right to choose whichever settlement company they want to work with, and that, because they chose it, that doesn't mean the settlement company works for them. The settlement company is a neutral party. They don't work for the buyer or the seller. They work for everybody. Okay. The next the next line item is recording releases, and that's about $50. The next 2-3 line items are taxes. The sellers have to pay, in Northern Virginia, this chunk of taxes when you're selling your house. Yeah, so if you're selling a house in Alexandria, Arlington, Fairfax County, Loudoun County, Prince William County, or any of the cities within it, you have to pay these taxes. Grantor's tax and regional congestion relief fee, regional WMATA. Washington Metro Area Transport something. Anyway, these taxes add up to 0.3% of the sales price. Right now, I'm estimating it's going to be sold for $1.2 million. Who knows, it's going to be a little bit more, a little bit less. Whatever you, as a seller, negotiated with the buyer, that sales price, that final sales price in that ratified contract, this tax is going to be based on that value. So it might vary a little bit up or down. The next line items are pest inspection, home warranty, well and septic inspection, or other inspections. In Bob and Mary's case, they feel very confident about how they're presenting their house. They regularly maintain their house very well, so they have confidence not have to call any inspector to do any pre-inspection. Of course, the buyers they have the right to bring their own inspection. They can even offer a contract with a contingency upon inspection. It's their right to do so. But for Bob and Mary, they did not want to have their home inspected beforehand. Some people like to do that just to know what's wrong with the house, and if they can, they fix some things. Some people just want to be kind of mentally ready. It's really up to the seller. Bob and Mary decided not to, so that's okay. To replace their carpet upstairs, they paid about a little bit less than this. This includes the deep cleaning costs too. So that $3,500 is the money that they spent to get their house ready to put it on the market. HOA, condo, or co-op disclosure fee. I already mentioned their house does not belong to any HOA association, so that's going to be $0. Other fees, $0. So if you add up all that money in the red box, the loan payoff, the county tax, the compensation, the listing and selling agency compensations, the settlement fee, the taxes, and the repair costs, they all add up to $330,000. And if you subtract that amount from the sales price, $1.2 million, Bob and Mary get to keep $870,000. Their actual plan is to move somewhere that they can afford a slightly smaller house than they had in a different county. And they're going to pay cash to buy their next house. So instead of paying additional 15 more years of mortgage, they're going to live from now on, or from the time that they sell the house, mortgage free. How amazing is that? I love it. I love it. I'm so happy for them. Okay, capital gain tax. Let me show you how I calculate the capital gain tax. Again, no, I'm not a CPA, okay? Their sales price is $1.2 million. And I don't know if I mentioned, Bob and Mary bought their house 15 years ago, and they lived in that house as a primary residence. So IRS allows you, if you just look back the most recent past 5 years, up to the sale of the home, in that window, if you lived in it for 2 years, either at the beginning or towards the end, or sporadically, it doesn't have to be consecutive 2 years, then as a married couple, filing jointly, you're allowed to earn $500,000 without paying any tax. So that's what this is. Capital gains exclusion, $500,000. They purchased their house for $500,000. They paid roughly $12,000 for their closing cost when they bought the house. They'll be paying $60,000 closing cost when they sell their house. How did I come up with that number? Well, the $330,000, the summation of the numbers in the red box, minus the $270,000 loan payoff, gives you $60,000. And also, they did the 2 out of 3 bathroom remodels about 6 or 7 years ago. They paid roughly $20,000 each. They did the kitchen remodel a few years back, spent $25,000. And if I add up all this, capital gain exclusion plus the purchase price plus each closing cost plus remodels, it adds up to be about $1,137,000. If I subtract that value from the sales price, $1.2 million, then you get the $62,000. So that's their taxable income, in addition to whatever income they make. But if you were to assume they're going to pay 15% capital gains tax, then they would end up paying $9,372. If you find this video useful, bookmark it so you can reference it later when it's time for you to sell your house. You can also subscribe to this channel. When I subscribe to other people's channels, I've been subscribing and then turning off the notifications so I don't get all the dings and dongs. Also, if you want to ask me a specific question privately, you can go into my website, achmavan.com, or you can ask it in the comments below. It's up to you. Thanks for watching. I'm Achma, realtor in Sterling, Virginia. Bye.